Hello, financial fans. Welcome back to another stock analysis. Today we'll be covering the Kroger company, stock ticker KR. Kroger is a retailer operating grocery and multi-department stores in the USA. We've got over 2,900 locations in the USA. Their market cap is currently sitting at $32.9 billion. And in 2021, they generated a revenue of $137.9 billion. The dividend yield is currently 2.04%. From their revenue, 50% of their revenue is generated from non-perishable goods, 25% is from perishable goods, 11% is fuel, 9% is from pharmacy items, and the rest are other various products. To determine our final valuation for the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, financial health, and the growth of the company. We'll be using a standard margin of safety of 25%, and this margin of safety can either increase or decrease based on the ratios that we'll get to in just a moment. The severity of how much it will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors in our scale, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. First two ratios that we're going to look at are the EBIT growth and the margin growth. The EBIT growth is very hard to see on this chart, seeing as the margin is very low, but it has gone up over the years steadily. The growth during this period of 2013 going to 2021, it was 2.8%, which looking at our scale means no change on our margin of safety. The margin has gone from 2.88% in 2013 to 2.4% in 2021. The average margin growth was actually a decrease, so the average margin growth in this case was minus 1.06%, meaning no change in our margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividend, as you can see, has gone down in 2014 to 2015, but they have managed to increase dividends again from 2015 going to 2021, going from 42 cents a share annually in 2015 to 84 cents a share annually in 2021. The average dividend growth was only 5.3%, meaning no change in a margin of safety. The payout ratio is sitting at a very solid 29.4% payout ratio, which means 5% deduction from a margin of safety. Since a low payout ratio means that Kroger still has a lot of room left to increase the dividends further. The final two ratios that we'll be looking at are the debt to EBITDA and the return on invested capital. To get a debt to EBITDA ratio, we have to take the debt, subtract the cash from it, and then out of this, we get the amount of years of EBITDA it takes for the companies to pay all of their debts. In this case, it's almost 3 years for Kroger, meaning a 300% ratio of debt to EBITDA, which is barely in the orange section, so no change in the margin of safety. The return on invested capital for Kroger is 7.6%, which once again means no change on the margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Kroger. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2012 all the way to 2021. The average growth in cash flow during this period was almost 30%. But since we're calculating with the lifetime expected growth in cash flows of the company, I'm gone with a very conservative 10% of the average growth, which is just under 3% lifetime expected growth. Using this percentage, we can determine the future free cash flow of Kroger and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. The sum of free cash flow then will be just over $73 billion. To get our equity value, all that's left to do is add our cash and equivalents and subtract the debt. Doing this, we get a $55.5 billion equity value. The last thing we need to do to get our discounted cash flow price per share is divided by the shares outstanding. When this is done, we get a discounted cash flow price per share of $77.61. And with the current price of $46.19, we get an upside of $31.42 here, which is a 68% upside. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts going from 4 years ago to the current year, and the average growth in dividends here was just under 14%. Since we're once again calculating the lifetime expected growth in dividends, I've gone with half of what the growth rate was in the last 5 years, which is almost 7%. Seeing as I had a very low payout ratio, I can see this 7% being achieved in the future. Doing this, we get a dividend discount model price per share of $57.27. And with the current price of $46.19, we get an upside of $11 here. And the upside is almost 24%. Last model that we'll be using is the multiple valuation. By looking at companies that do similar business to Kroger, looking at their stock price and their earnings per share, we get an average PE multiple in the industry. In this case, the average PE ratio here is 11.67. All that's left to do here, to get our fair value, is multiply by the earnings per share that Kroger is generating. And in this case, that's $3.70 per share. The fair value here, in this model, is $37. And with, again, the current price of $46.19, the upside is a downside of $9.19, which is almost a 20% downside. Let's go look at the final overview of our valuation model next. Looking at our final overview, we have imported the discounted cash flow, discounted dividend, and the multiple valuation price per share. And out of this, we get an average of $57.29. If we would not use a margin of safety here, we would have an upside of 24%. But we have calculated our margin of safety earlier, using a standard margin of safety of 25% and a deduction in the margin of safety of 5% because of the payout ratio. Then we have a remaining margin of safety of 20%. Leaving us with a fair value of $45.83. This is a downside of 0.77%. So in this case, the intrinsic value is very close to the actual price of the stock price now. But it would be just a sell by a tiny margin. I hope you enjoyed this video. If there's any other companies that you would like to see on this channel, please let me know. Thanks for watching.